All right, everybody. Welcome back to Strongman Personal Finance. I hope you like my new hat. If you enjoy my channel, please like, please subscribe, and please hit the bell button for notifications. I know it's hard to do, but you can do it. I have faith in you. Today, we're going to talk about the current coronavirus or COVID-19 pandemic and what you should be doing with your investments. Right now, if you're young, this is an excellent buying opportunity to buy shares of index funds while they're on discount. Look at the history of the stock market. There have been dozens of crashes, but guess what? The market has always recovered over time. So if you sell your stocks right in the middle of the crash, you're locking in the losses of those stocks. If you don't sell and you hold those stocks, you're not realizing any losses. You continue to own shares of those companies. And if you continue to invest in the stock market, you're buying stocks when they're on discount. Let's say your portfolio is heavily invested in US stock indices, the NASDAQ, the S&P 500, whatever. You're heavily invested in US stocks. If you're young, there's only one assumption that matters. Do you believe America and American companies are going to be profitable and innovators and world leaders in the far future? If the answer is yes, you believe America is going to stay on top and continue to produce amazing companies that bring value to people around the world, then you should not sell your stocks right now. As a matter of fact, you should buy as many stocks as you can right now. That's because they're on sale. You're getting a once-in-a-lifetime opportunity to buy stocks at a discount. This is a temporary market crash. Everything is shut down. Businesses are losing profits or not making money at all. And a lot of small businesses are going to die. But if you're investing in large companies, like in the S&P 500, you're going to do okay in the long term. Most of those companies are not going to go bankrupt during this crisis. As a matter of fact, in the long run, they're going to recover. When you're young and you're investing for retirement, the whole purpose of that investment is to hold it for the long run. It's not to day trade and try to time the market. People suck at timing the market. Most people have no idea what they're doing. And most professional fund managers have no idea what they're doing. If you compare actively managed mutual funds to index funds usually always beat actively managed funds. And those are the professionals. So how in the hell do you think you're gonna beat the market when even these educated clowns can't do it themselves? Trust me, if you try and time the market, you're gonna lose. Most people don't know what they're doing. They watch the news, they see people freaking out, and they think now's the time to sell their stocks. That's not the time to sell your stocks. As Warren Buffett said, you need to be greedy when other people are fearful, and fearful when other people are greedy. And I'll even tell you what I'm doing personally. Right now, I'm dollar cost averaging a lot of money into the NASDAQ index over the next couple of months. Why? Because the companies in that index are on sale. I can get those companies cheaper, and I know, or I'm very confident, that in the long run, 20 or 30 years from now, those companies are going to be way more valuable. Now, people say that stocks are risky, and that's true. If you own one or two stocks and your entire retirement savings is in one or two stocks, yes, you're taking on significant diversification risk. But if you own hundreds or thousands of companies in your portfolio, you're taking on much less risk. If one company goes bankrupt or sucks, they just remove it from the index and they put on a new company that's doing better. So over time, if you're investing in index funds, you're investing in the biggest companies and the most successful companies that are in that index. Let's think back to the Great Depression. Let's say we're about to enter one of the worst depressions in the United States, just like the Great Depression. Well, in 1929, the stock market crashed significantly, and a lot of people lost their money. They saw the market crashing, and they sold. What would a smart person have done? A smart person would have kept buying stocks throughout the Great Depression. Yes, stock returns were pretty crappy during the Depression, but guess what? 20 to 30 years down the road, the stock market was way higher. So if you were somebody that was investing in stocks throughout the Great Depression, like if you're dollar cost averaging perhaps, in the long run, you would have got a bunch of shares extremely cheap, and you would have made a ton of money in the long run once you sold 20 or 30 years down the road. You need to remember this concept. You don't lose money until you sell a stock at a loss. You don't make money until you sell a stock at a gain. If you don't touch your portfolio, you don't lose or gain any money. It's a paper gain or a paper loss. Does that make sense? So in conclusion, this is a temporary economic setback. Could take 1 year to recover, could take 3 years, could take 5 years. Doesn't matter. If you are not going to sell your investments for 20 to 30 years, it doesn't matter what happens to your investment right now. It only matters what your investment balance is when you sell it. So if your investments are looking like crap right now, that doesn't mean anything. If you're young, keep investing in the stock market. It's one of the few ways that you can beat inflation over time. If you don't invest in stocks, if you invested bonds, for example, you're barely going to beat inflation, and you're not going to really be set for retirement. Stocks are one of the few ways that you can stay well ahead of inflation and potentially have a nice retirement. If you don't invest in stocks, you're going to have a hard time building the amount of money that you need to live off in retirement.